There are so many tools available to us as investors to be able to participate in a business's success that often are farmed out by other firms and often are farmed out by other investment teams at other places. We have found that we'll have much better success being able to pick those opportunities ourselves. We have a first principle that we employ, and we've employed for the 25 years that I've been managing portfolios, and that is to always reconcile risk with returns. It's in fact a risk-adjusted return type approach to managing portfolios for our clients. Now, we don't favor any one particular style. In fact, I've always said that, we'll buy growth and we'll buy value, because oftentimes we find growth in value securities and defensive businesses, and we find value in growth businesses. And we don't want to limit ourselves to the type of security or the way we construct portfolios for our clients. And then lastly, we're generally agnostic when it comes to the type of security that we're putting into the portfolio or that we're allocating our clients' capital to. We focus on income, we focus on risk, we reconcile it with returns, and that has generally been the hallmark of what we've been able to deliver to our clients and our unit holders over the last 25 years. Well, our investment process is simple yet somewhat complicated. We employ a bottom-up and a top-down methodology to managing or allocating capital for our clients and our unit holders. 70% of what we do is bottom-up. It's the security selection part of it. It's the strategic part of what we do on a day-to-day basis. Buying securities, buying businesses, and having certain expectations of returns and risk over the long period of time. The 30% of the process is top-down, and that's generally taking into account what we know about the economy or macro conditions and how that'll affect the risk and the return and the volatility of our portfolios over time. Now, our 5-step process is first starts with cash flow. Analyzing cash flow, the stability of the cash flow of the firm, the growth, basically the income part, which is one of the things that we focus on generally in managing the portfolios. Secondly is the profitability. And the profitability is important to us because it not only helps us to value individual assets and lines of businesses, but it also helps us to analyze or mark management's execution of their priorities, the things that we expect them to do. Valuation is down the list, of course, because we are business buyers. We have a long-term perspective, but valuation is very, very important. And in the 25 years that we've been managing clients' portfolios, we know that different valuation techniques should be used based on whatever particular asset or line of business that we're trying to value. And we think that's very, very important to be able to match the proper valuation technique to the line of business or the type of asset we're valuing. Fourthly, catalysts. We think catalysts can be a very important short-term tool. Mispricing, looking for mispriced assets or lines of business within an organization, looking for secular growth opportunities within different industries. Those types of catalysts generally make it into the portfolio when they become apparent to us. And then lastly, and probably the top-down part of this process is risk management. And we use risk management tools to generally improve the volatility characteristics of our investments and the portfolio in general with different techniques that we use. What I found over the more than 2 decades that I've been managing money is that whatever tool you can employ to be able to not only identify those opportunities when they present themselves, but also identify the risks when they present themselves. One of the best ways to do that, again, is to look at the capital structure, having the ability to see where the value, where the risk is within a business profile. And that's being able to buy the bonds or the equities. The convertible bonds, the preferred equities. There are so many tools available to us as investors to be able to participate in a business's success that often are farmed out by other firms and often are farmed out by other investment teams at other places, where you have multiple individuals looking at and contributing to the sort of construction of the portfolio. We have found that we'll have much better success being able to pick those opportunities ourselves by, again, investing within the capital structure. We know as market participants that every day there's a new story about where the return or the risk will come from. Big part of our job is to sift through that noise, and focus on the things that will deliver the long-term experience and the long-term results that our clients have come to expect. So when you look at income, there's an undeniable fact that income is responsible for a very large part of investment returns, not only on a sort of intermediate term, but especially on a long term. So when we know that information, and we know that that is part of an important part of our unit holders and our clients' experience, we want to be able to do a really good job identifying, sustainable income opportunities. And again, back to our 5-step process, the first step is cash flow, the analysis of cash flow, the sustainability of cash flow, and the growth of cash flow. That sort of parlays itself into, sort of the income aspect to the investments that we employ in the portfolios. If I had to use one word, I'd use collective, but you've got to add, I think, the word mission to collective. So the collective mission, it's the coming together of the employees' individual skills into a teamwork framework. It's the collaboration that you have at iAGAM. It's the support that you get from management to be able to achieve the things that we've set out to do. And most importantly, when all of those things come into place, again, you produce the experience that is expected from not only your shareholder base and the people investing with you, but you're also producing a pretty good experience for the people that work with you. And I think those are 2 or 3 of the very important hallmarks of the culture at this firm. Well, the root in history, focus on the word history. And in almost anything that we do, and I've mentioned this word many, many times, the word trust. Well, what do you get with a long history? And clearly, we've got a history of over 100 years. You get experiences, you get collective knowledge, you have a focus on core principles of how you do business and the reasons you do business and the services and products you provide. And I think all of those things, with this long history, with this over 100 years of foundation that has been laid, those things, when they come together, they set you up in a pretty good place to continue to not only improve, but also lay the foundation for the next 100 years. And I think that's really important, especially in our business. Having a history, having these experiences, and importantly, having this foundation. So as we move forward, we're not limiting ourselves to any one particular type of outcome. Well, I'd use the words that you have to hear: transparency and accountability. You want to hear those words. But again, I fall back on the intangible. The word that makes us comfortable, that makes us confident that investing with iAGAM as a partner and helping you to achieve your investment goals, you've got to have the word trust in there. And all of these things come together. We've talked about the longevity, we've talked about the history, we've talked about the people and the teamwork and the collaboration. When all of these things come together, I think that word, or those words, accountability and transparency, actually mean a whole lot more than they do just on paper.